Hello everyone, welcome back to my YouTube channel. In this video, I'm going to discuss about the mutual fund versus stocks. Okay, so let's begin the video. So starting from mutual fund. See, in the mutual fund, there are many ways where you can invest. The one of the way would be a systematic investment plan, so named as SIP, or the other way we can do it as a lump sum. Okay, so when it comes to systematic investment plan, so most of them prefer a like monthly investment, or it depends on the individual. Sometimes you have option to go with the weekly SAP as well. So it's completely depends on the individual how one can choose accordingly. Whereas when it comes to the lump sum, so for example, anyone has the lump sum amount of 1 lakh or 50,000, and if they want to invest in particular sector, so they can go ahead and do it accordingly when it comes to mutual fund. Okay, so there are two different ways, SIP and the lump sum way, where they can invest in any of the mutual fund. Okay, so when it comes to mutual fund, so where like each and every mutual fund has the fund manager, so where they'll be rotating the capital based on the sectorial, based on the stocks as well. Okay, but however, so when they are investing in any of the stocks, so even they do have a restriction on the maximum percentage where they can bet on particular stock. So they cannot invest in all eggs in one basket. So for example, if you're investing in a small cap sector, okay, if the mutual fund is belongs to small cap, so if they're betting on the particular stocks, so they can't put 100% to the same stock itself, right? So it's a risky bet, because where the mutual fund manager will be handling the thousand, like 10,000 crores, 1 lakh crore, and so on. They can't bet everything in the one stocks. Because of that, because of the diversification, the fund manager will be diversified into different stocks, so that the risk will be limited to that. You can't expect the exponential return via mutual fund beat any index. There is a maximum cap where they can go up to, correct? So because of that, so the return is also a bit low compared to the index or compared to the individual stock performance. Of course, the risk will be there in both. For example, if you are investing in particular stock, until unless if you don't do a proper technical analysis or fundamental analysis, you'll not have a confidence to bet on that stock. However, mutual fund manager and the team, they have a good number of expertise, and they can take a better call. But still, so however, for example, if you're an experienced trader, or if you know about the technical analysis about the particular stock or particular patterns, where we had discussed in the past video as well, like high patterns and the swing trading strategies, so one can bet on individual stock as well. So that advantage doesn't has it in the particular mutual fund managers. Okay, so they are forced to bet on the large cap stocks, and which are less riskier than the betting on the micro cap stocks. They can't do that. For example, if you're investing in the small cap stocks, so they can't go ahead and buy the micro cap stocks, right? So these are the, like for example, if you're betting on the particular stocks, okay, you found out that okay, XYZ stock has a good potential to go up, and it's forming the higher high or breakout, so you can directly go ahead and buy the individual stocks as a direct stock picker. But whereas the mutual fund, they can't do that, correct? So that's the disadvantage has the as a mutual fund manager, as a group. Okay, because you'll be restricted to the certain extent of the return. You can't expect the exponential return when it comes to the uh, mutual fund investment. For example, if you're picking, see, when it comes to the stock investment, if you're betting on 5 to 10 stocks, okay, you'll be maintaining the strong like SL and target as well, like with the minimum 1 is to 2, 1 is to 3. So based on the risk to reward, you'll be betting on. However, so in the worst scenario also, like if you're thinking that okay, 30% or 40% times that SL will hit, but still the rest of the times it can give you a better return than the mutual fund and the stock which are hit the SL as well. So the probability is more when you properly follow the risk reward ratio in the stocks. I hope it's clear. So let's understand that one of the famous mutual fund house, which is Parag Parikh. So the famous one was like for the like flexi cap fund. See, for example, here you can see that um, Invesco India Flexicap Fund, HDFC, Parak Parik, HSBC. You can see that 1 year return is 2.8%, 6.5, 5.9, 0.5%, and minus 1.2%. So these are the yearly return, right? So on top of it, you'll be paying the expense ratio. Additional to that, you'll be paying the exit load as well if you're exiting within a year. See, these are the additional charges on top of it, you'll be paying for it. You might sounds like, okay, for 0.5% or 1% will be very less. But over the period of time, if you're holding it for 5 to 10 years, it will make a huge difference because you will be paying the expense ratio on the every unit you're going to purchase it, correct? But whereas in the stocks, when you're going to do it, so you're not paying any expense ratio, you're just paying the brokerage charges at once, right? And again, for example, if you're investing in any of the individual stocks, and if that company declares any dividend, you're going to get the direct beneficiary out of it. But whereas when you're investing via mutual fund, even that those companies which are giving a dividend as well, you cannot get that dividend, right? So as a direct stock picker, you will be having that advantage of getting the dividend as well. But whereas in the mutual fund, you will not get a benefit of dividend as well. Okay. So I hope it's clear. So overall, what I can suggest you, if you're an experienced trader, if you're in the market for 3 to 5 years, you know how the market has performed, when to enter in the market, so where to keep a stop loss, target, if you're doing a swing trading, or if you're betting on the long term also, you'll be knowing about how to track it better, correct? So in those scenarios, so better to take a stocks rather the mutual fund, okay, so that you can expect a slightly better return than the mutual fund, correct? And you'll be owning the those stocks, you know the risk and you know the reward as well, right? So that you'll have a like expected return also based on that. But whereas in the mutual fund, we do not know when they're going to enter into the particular stock, when they're going to rotate it. So it's completely it's not in our hand. So once you invest in the particular mutual fund, it's completely up to the mutual fund manager how they will take it further. Again, it's not guaranteed that okay, last year Parak Parik has performed better, so this year also it will do well. So it might not be the case. So you can see that, so last to last year it has given a 20% return, 25%. So now we can see that as per the market, it is giving up to 5% and 2% like that. On top of it, you will be, irrespective of that, you will be like profitable or not. Anyhow, you have to pay the like expense ratio and the exit load that has to be paid. So but however, if you're looking for the decent return, so not to track the market, so then better you can go with the SIP. So I'm not saying that mutual fund is bad, but if you're a fresher, better to go with the mutual fund. But if you're experienced in the market from past 3 year 5 year, so then you can go with the stock picking, so that you will have a better risk to reward and the better return perspective as well. Okay, so I hope it's clear. That's all it for today. Thank you so much for watching the video, and I'll see you soon with the new exciting video. And do subscribe my channel and hit the bell icon. I'll see you soon. Till then, take care. Bye bye.